as a reason why tech valuations are going down when you consider discounted cash flows over time. So I have the great opportunity to be involved with on a board of a number of different fintech companies and in that universe. And I have to say this, the raising of the interest rates have had zero, and I mean zero, impact on product development, product innovation. It just doesn't matter. If you're trying to build the next great widget, right, the fact that the rates went up a half a point doesn't matter at all. So that's really not, I think, a valid impact on valuation. But the other side of the story, when you think about technology companies, right, you have to start with the base metric is what is the earnings, what is the cash flow? The young tech company says, well, that's not good enough for us because, one, we're growing very fast. We have to make these investments. We have one-time charges. You need to look at the business this way. And what's important to note is that is a valid way of looking at the businesses. And it's important to know that most times those stories have great validity to them, and tech has grown dramatically over the year. But now, in this raising interest rate environment, we are not in story time anymore. We're really in show time. So I think we'll be in show time for a period of time, and that clearly will have an impact on tech valuations.
So just looking at the public markets then, we'll start there. Do you see this as a shift back to fundamentals? And if so, what does that mean for the more speculative tech names that have gone public in the last year or two that might not only be unprofitable, but pre-revenue and have fallen so much already?
Yeah, so that's a story they're telling, and those stories are going to be difficult to receive by investors. And when you look back in the dot-com era, right, we had the bursting of the bubble, and it stayed that way until 2004. When I came to NASDAQ in 2003 with 0 IPOs. In 2004, Google came public, and that really changed the narrative. But it took 4 years for a company of the quality of Google to change the narrative that you could listen to a company that had high growth aspirations, and certainly they deliver over time.
To go back to the point you made about fintech, we've obviously seen the IPO pipeline largely dry up this year. I know Bausch & Lomb is expected to price and begin trading today, which is going to be the second big IPO since we saw TPG go public in mid-January, which speaks to how quiet that activity has become. Is there any incentive right now for some of these private companies, particularly in fintech or tech in general, to go public, or does it just make sense for them to sit on their hands and wait, given the fact that interest rates aren't necessarily having a big impact on their product development?
Sure. So tying it all together. So if I'm Google and I have the Google business model, I can go public at any time. Investors will see that's real. But clearly, for a regular company, the burden of showing me is higher today than it's been in the last 5 years. So if you're an IPO where you have a story that has some holes in it that's not public, that's not perfect, then it's going to be a difficult time to go public at what I say is a full and fair valuation for this period of time. So when you see the markets change, they generally change by having really the perfect candidate, the Google, come forward that changes the narrative, changes the viewpoint, changes the way people have and the mood about things. So Bausch & Lomb to go public today, that's a high burden for them to carry, all right? And it's not one that a normal company can. So as I'm saying, we're in a show-me period of time. Stories will be listened to, but they're going to be risk-adjusted certainly a lot more dramatically than they have been over the last 4 to 5 years.
Bob Greifeld, always great to get your insights. Thanks for joining us today.
My pleasure.
Just getting